the interest rate. So we're going to take some time to do that. We'll talk about inflation and what gold did and what we might expect gold to do in the future, why we would also be looking back to look for those metals and miners. So to start, hello, good morning, good afternoon, depending where you're at. You just crossed over to the afternoon for the East Coasters and evening for those on the other side of this spinning marble. All right. What have you seen as far as rate decisions? What do we know as far as rate decisions on a global scale? Because as we're watching this, what does lower rates mean? In the end, what does it mean? What does it mean in the short term? What does it mean in the long term? What might we expect? And what data have we been given today? Tell me what you think. What do you think? And to talk about this, let's go over here and let's look at some of the data that's come out this week. We can narrow this down and get some other pictures here, but here's the deal. We're going to go into this and let's start with just the US economic data. What do we get reported? We get stuff that's reported that is not government. And so the market is desperate, begging for information. The market wants to know what information is out there so that we can make decisions, that we can put pressure on. Buy the rumor and sell the news, as Kristen says. Exactly. Hello, Minu. How are you today? Good morning, Trains. J9. Carlos. Good morning, Maori. Good morning. Gold is a hedge, right? So we'll talk about gold and that move that we saw there. Why would gold tank if rates are lowered? Why did we see gold go up in the overnight? Well, that's what we're talking about. We're talking about their pricing in and how much did we price in? Did we price in enough? What do we think is going to happen next? So we're going to go through all that. We're going to talk about this and try to define the next trade. Good morning, Rosario and DGen. Hello, Hashpipe. Neil. Good morning. Since you're yelling, I figured I had to yell too. All right, if we go above R2, then we'll test it later. Okay, you're talking about specific trades on that one. And looking here, this is what we got this week. Not a lot, right? Not a lot of information, but a couple things that we have. We actually have Richmond Manufacturing Index, which is not government. We have CB, Consumer Confidence, and that's a Commerce Board or Consumer Board, Commerce Board. I can't remember what the C stands for. We can pull it up here in a second. And then this is by the National Association of Realtors. So all of this is non-government reports. And all of this is the Federal Reserve here coming up shortly. So we're going to see that. We expect it to go to 4%, dropping down 0.25. All of that is inflationary. Historically speaking, if you were to go into any two currencies, what you'd be looking for is the differential of those interest rates. It used to be, back in the day, that all you had to do is buy the US dollar and sell the Swiss franc or the yen. Because if you were buying the US dollar, this is what we call the carry trade. Is everybody familiar with what the carry trade is? This is why today is important. Where do we give way to weaken the carry trade? Where do we see market stimulation from borrowing? And where do we see a weakening currency because of lower rates? This is this 3 data points. It's like those switches, you know, that you can have 2 on at any time, but you can't have all 3 or all 3 on or off. All right, so Japan is less than 0.5%, and Swiss franc is 0%. Theoretically, if we bought the US dollar, meaning we got US dollar deposits, if you're an international bank, a multinational enterprise, an MNE, if you're an MNE, you would get 4.25% for your deposits in the US dollar. If you were borrowing Swiss franc or Japanese yen, you're paying in essence 0%. We'll say 0.25% since it's between that and that. Theoretically, the differential here is if you're borrowing 0.25% and getting 4.25% deposits, you're getting 4% to carry this position. This is the carry trade. The carry trade is made even more dramatic if you're trading in the currency world and not actually putting deposits and moving them around. Multinational enterprises and banks will sometimes just move deposits. But if you are actually holding a position in the currency market, you're getting that 4% on, say, $10,000 on one mini contract, and you're getting that 4% a year, and it only costs you $200 of deposits to do it. So you're using $200 of margin to get paid $400 a year per 10,000 in a mini. Now, where else can you get 200%? You paid $200 here of deposit, not even risk. We could talk risk later, but you're getting paid $400 of interest. So this is your interest and this is your margin. So for your $200 of margin, you're getting paid $400. This is the carry trade. This is why the carry trade is so attractive. Back in the day, the pound gave you 6.75% and the yen charged you 0%. And so people were getting 6.5 times. And by the way, back then it wasn't 50 to 1, it was 400 to 1. So for $25, you could control $10,000. For $25, you could get paid $675 of carry. This is why it was so attractive. This is what the carry trade is. So the question is, does the carry trade continue? Or if we cut rates and cut rates and cut rates and cut rates, does the attractiveness of the carry trade get small enough that we really aren't making decisions based off of this? And the short answer to that is yes. When we went into quantitative easing, there was no carry trade. No one was chasing a 2% differential. It just wasn't big enough. It wasn't attractive. But when we're 4%, that becomes attractive. If the US is cutting rates from 4.25 to 4, well, we're still at this nebulous number. It's between 4.375 down to 4.125, but we'll just do what they're reporting here. And 4.25 to 4, that doesn't end the deal. It doesn't end the central bank rates. It doesn't end the discussion. It's still a situation where we're seeing lower cost, less restrictions, more free money, which will create inflation and diminish the value of the carry trade. So if we go back to the carry trade, and I know Gianni talks about this and I talk about it, and when we're looking at this rising is carry trade. Higher highs, higher lows, higher highs, higher lows is buying the US dollar and selling the Japanese yen. So at this point, we're saying, no, we're buyers, we're buyers, we're buyers. We're collecting that interest rate. If we went back, this is just 6 months. Not only do we get the interest rate, depending on our timing of this, we get the appreciation of the underlying instrument. So right now, we're roughly the exact same price we were a year ago. But we also know that we had rates cut, we had discussions of that, we had the rate bottom out, we had the no rate cut, we had a rate cut over here. But if we're buying the lows and holding it and just letting it trend, we can get paid that 4% at 50 to 1 leverage. So it's as though we're getting paid 200% on our margin. And we also have this appreciation of the underlying asset, which would also pay you an additional $1,400 in 6 months. This is the reason why the currency markets are so important, especially on days like today. If we look at this and focus on just what we're seeing in this current time frame, notice where we've gone, notice where we're at, and you tell me, are we still interested, no pun intended, in the carry trade? If we're going to see rates cut, does this look like a time you should buy this chart or sell this chart? And we're going to find other opportunities in other instruments because of this. And we're going to get back to that pending home sales and what that really means. All right. While you're talking about that, while you're thinking about that, let me show you one other thing. Just today's movements. When we're talking about interest rate cuts, and we see the dollar is flat versus the yen. This is indecisive, but yesterday the dollar was losing versus the yen. Today it's flat versus the yen. Movement of currencies today is relative to the other currencies. So we're saying, how's the dollar doing versus the yen? How's the dollar doing versus the euro? How's the dollar doing versus the pound? And if we look at this and say, well, since we're talking about inflation, that if we're cutting rates, we should see inflation pressure, notice that gold has gained against every major and secondary currency today. Gold's gained against the Australian dollar, the Brazilian real, the Canadian dollar, the Swiss franc, the Chinese yuan, the euro, the pound, the Hong Kong dollar, the Indian rupee, the Japanese yen, Mexican peso, the ruble, US dollar, and the South African rand. All of those, that's what all those are, all of those have lost to gold. Gold has gained across the board. This is the inflation right here. This is the inflation pricing. Gold has gained against every currency, every major currency today. So as we're looking at this, gold inflation hedge is in play. It doesn't have to be against just the dollar. It does. You could do gold versus the euro. You could sell euros and buy gold. You could sell pounds and buy gold. In fact, one of the biggest moves we got today was in the pound down. So the pound, we're going to stack this. The pound lost to the US dollar and has been losing to the US dollar all the way since September 17th. Lower highs, lower lows. Notice the breakouts. The monkey bar breakout said to go short here, said to go short here, said to go short here, and has reached all of its targets repeatedly. Actually said to go long here and hit that target. But all the way down to this balance and fair price. So the pound has been losing, losing, losing all the way down through here. If the pound is losing across the board versus the US dollar, and yet the dollar, this is gold quoted in US dollars. So think of it like this, gold slash USD. Gold has been gaining versus the US dollar since September as well, actually since August. But even if we went from September, this is the, if A is greater than B and B is greater than C, then A has to be greater than C, and it's going to give you the bigger differential. If gold is greater than the US dollar, and the US dollar is greater than the pound, then the gold versus the pound is a greater differential and a greater opportunity. What we're seeing is universal inflation hedging. It's not just with gold versus the US dollar. This pullback in gold that we saw came right back, bounced off the monkey bars and said to be a buyer today, and it went right to the target and has faded back. This price action, if we drop this down into the intraday, you can see that we traded up last night and we broke out middle of the night in the UK and European trading sessions. This is when they opened and we started pricing in that inflation hedge. As we pulled back to fair price at 4004, we actually had a short signal here, a short signal here, a short signal here. All of those would have hit the targets, depending on how tight you made your stop. But what we're seeing is that the inflation hedge is priced in, and now we're maybe overpriced it. We priced this in all last night. Canada cut rates today, so we'd expect that to create global inflation. US is cutting rates today. We expect that to impact and increase global inflation. The more currencies that cut rates, the more currencies that put more liquidity, more cash in the market, and the more inflation hedges are going to happen. Is it making sense? Are you with me? And all of you that are saying sell, we had one that said buy, double top, sell, sell, sell. So more of you are saying sell than buy. So the question then comes back on this dollar yen. Get back to that chart. When does the double top confirmed, Maori? If you're selling here, I do say it's a sell signal based off of the monkey bars, and we're kind of owed this 151. But as we're looking at this, the thing to remember, like I showed yesterday with Gianni, is that the yen is the fear side of this equation. The Aussie is the greed side. The dollar yen is just a carry trade. How extended, how leveraged are you willing to be for 4%? Think of it this way. Think of this chart, this dollar yen chart, and you could do the same thing by shorting the 6J futures. But if you were in this trade, if you're saying we're talking about 4%, 4% interest rate, if you were in the trade collecting 4% interest rate, how much leverage would you be willing to take to be in that position. To make an equivalent, how leveraged would you be willing to be? How much margin would you be willing to do? If they let you, how far would you leverage up to buy bonds right now? What do you think? To make a comparison, we're talking about getting 4%. That's what the carry trade is, getting paid a certain interest rate, a differential, while we get the leverage and collect more and more and more. So TKI says as much as you could find. And when would you want to be out of that, TK? Or you're just TK6. There we go. It's looking at the wrong thing. When would you want to be deleveraged and out of the trade? And again, whether you're talking about bonds and collecting 4%, or you're talking about the dollar yen and collecting 4%, if you're going to trade with leverage, how much would you do? He said as much leverage as you could get, as much as you could buy. And I've compared this before. I've told the story. If this helps you understand the movement of money, I've said this before, many of you maybe haven't heard this. I live at one of the largest freshwater lakes, and freshwater is a very loose term. It's got a lot of algae in it. This is Utah Lake. I live right here. Brandon lives right here. This is about 110 miles to go around it. Okay, about 110 miles to go around it. It's only 9 miles to go from here to here. I'll come back and I'll restate the question, Herb. But if we're in here, here's the thing. If my bank over here, I have a bank. I'm giving you a different analogy. If I have a bank here and Brandon has a bank over here, if I have a bank that will let me borrow at 0%, this is really what we're talking about. And I have my boat, which I couldn't get to start yesterday because I'm trying to winterize it. This is not a good thing. We'll see what happens there. But if I have my boat here, and I can borrow at 0%, and I can go deposit in his bank at 4%. How often would I do that? How much leverage would I do? How much borrowing would I do? Would you borrow $1 million? They're going to give me 4% over here, and I get to borrow at 0% here. Would you borrow $1 million? Would you borrow 2? Would you borrow 3? Would you borrow $5 million? Yes, because it's US dollars, US dollars. You should borrow and leverage up as high as you can. That's what the carry trade is. The difference is it's not just a little lake. This is not a lake that's 110 miles across. This is an ocean that is 10,000 miles across and has different geopolitical uncertainty that impacts it. So if we're in this and we're looking at this, it's not one country to the next. It's not one county to the next. It is country to country, different monetary policy to different monetary policy, where you could have this currency over here that you have all the deposits in. You could have Brandon's bank go to the point where the money that you have there drops in value 40%, 50%, depending on what you're seeing. Oh, but even if it's only 2%, remember, we're talking leverage. So yes, I'm getting 4% a year with $200 risk, right? Or $2,000 or $20,000, whatever you want to do as far as that risk goes. But if this drops 2%, you're losing the same leverage in days. You could lose a 2% drop here, wipes out 6 months of that interest rate, and could happen in 2 days. And if the bank starts to raise costs or lower, or if Brandon's bank says, oh, we're now only going to pay 3%, how interested am I in leaving that money there, and how much demand? Think about supply and demand. Supply and demand says what? If I have a higher interest rate, I demand more of Brandon's bank's currency. If he's now only going to pay 3%, the demand goes down, the value of his currency goes down. And if the value of his currency goes down, I'm leveraged up. A 1% drop, a 2% drop can wipe out 6 months of that payment. And if he lowers it to 3 and it drops 2, I've just lost 9 months of interest payment in the value right there, 2 days. So now I ask the question, how much leverage are you going to take? If you can lose all that interest payment in 2 days, where you'd have to sit and hold it for 6 months, and that's assuming there's not other things that weaken the currency, like more spending. How much leverage do you really want? Ron says my boat would sink halfway across. Well, I hit my stinking prop on the place called Pelican Point out here. I was out 50 yards, and apparently there's rocks underneath there. I hit my prop just a month ago. So yeah, you could sink your boat. So this is what we're talking about. So what causes us to unwind this? Why would we not want to stay leveraged into this? Is because the dollar could weaken faster than the yen and faster than the combined's paying you interest rate. When we get uncertain, when we get fearful, when there's changes in monetary policy in Japan and the US, like today, both of these are today, we see volatility rise and we see the unwinding. So all the people that borrowed money, like me on my little picture of my boat in the lake there, and as we're going through there, I've got that 0%. I'm going to unwind it, which means I'm going to take the money back and pay off that debt because I've borrowed at 0%. But if I'm losing more, then that's a problem. That's why the yen is a volatility trade. So let's go here really quickly, and we're going to set up the yen as a volatility trade and Bitcoin as a volatility trade. And we're going to throw that correlation study in again. That correlation study is the mathematical equivalent of how well do they move together. Okay. I'm going to compare the US dollar, Japanese yen to the VIX. The VIX is measuring equities. Why in the heck would you use the VIX to measure two different currencies that aren't US equities? Because there's still a correlation that we're looking at. We're still looking at the correlation, and what we're looking for is the inverse. And like I've said before, you really can only go to 1 and -1. There's no such thing as going past those levels. So what we want to do is say, are we correlated? And anything below 0 is inversely correlated. Let me do a box on here instead. And again, this is why this is important today. We had this going back and forth outside of normal correlations. The Aussie yen and the dollar yen have a history of being highly inverse correlated to the VIX. That is saying when volatility is rising, this pair is falling. That's what that inverse. Now we're inversely correlated at 81%. If the volatility is going to rise, we're going to cover our short yen, our selling of the yen, our 0% borrowing, and give back our dollars and close out our yen short position. That's what's happening here as we create these equal highs and a breakout here. We have a very high inverse correlation. It is a volatility play. So even though we're talking about interest rates and depositing currencies, which are the least volatile instrument out there, these can have an implied volatility of 5%, 3%, 6%. And when we see this entire year, it has only moved 8%, 7% on one of the bigger years. Very low implied volatility, but we still have this inverse correlation. If volatility is rising, if uncertainty is increasing, we unwind the carry trade. Today, the US dollar is cutting rates. Canada already has cut rate. The Bank of Japan is talking about their monetary policy. We still have no government data. And so the more this happens, the more the volatility increases, the more this is likely to pull back. Now, I'm not saying you're going to confirm the double top or fall all the way back down to 148, but technically, it seems to be suggesting the same. The Aussie yen is one that it benefits from both an interest rate differential and from gold. So gold is rising today, and it says, hey, with gold rising, maybe we're willing to take that risk. We still haven't closed through the high. The inverse correlation is still 82%. It's a little bit different than the US dollar because they get the benefit of rising gold. If we take a look at the crypto, it's the same thing we talked about yesterday. It's the idea, the volatility. If you think volatility is going to rise while we cut rates, then you should be selling. And I said this yesterday. Sorry, Gianni. I said I would sell here. I will take the opposite side of your trade. And it's all because I trust that volatility will keep Bitcoin from rising. And what happened? Doesn't matter that we're cutting rates. The volatility is winning. Bitcoin is a volatility asset. Low volatility is a risk-on behavior, and we buy Bitcoin. We are uncertain. We have a 70%. We've stayed in this inverse correlation for the last month. And as volatility is rising or stabilizing and moving up, we're seeing this go down. Now, if we take a look at the VIX a little closer, and this is all setting up for so we can find some trades here. Yes, you could just simply take the VIX, or sorry, the Bitcoin short. You could also be looking at this, and I commented yesterday, I do think this is the bounce. And we bounced and we moved up a little bit higher. I would like to get above 18. I said we're going to target 20 and then potentially up to 25. And so I am bullish the VIX. I am bearish Bitcoin. I am bullish the Aussie yen slightly, but I'm more bearish the dollar yen as volatility plays together. Does it make sense? This is math. We always want to look to say, why did this move? Why did we think this is going to move? We always want to have a culprit. I'm saying the correlation is telling you if volatility is rising, you would expect to see reduction of risk. Just that. I'm not saying how they're going to do it. But if we're talking about reduction of risk, as volatility rises, uncertainty rises, risk premiums rise, and the market has a harder time making the market, we reduce risk across the board. And if we're going to reduce risk across the board, leveraged assets go first, which is Bitcoin, the dollar yen, the Aussie yen. And that's what we're looking at. So as we're looking at all these moves, there's no such thing as one catalyst. We're talking about a global market that's moving everything. Now, as we're looking at these, we look at these moves through here. I don't know what's doing it. I don't know what's causing it. I don't care. All I know is if volatility is going to bounce and rise, we protect, we reduce risk, we eliminate risk. That's behavioral economics 101. Rising uncertainty causes us to reduce risk. So where is it that we're going? Timothy, the correlation study, that's what that math is. Are you a mathematician? Do you want actually the correlation calculation? It's in Excel. It's in here. So where I like to use for the correlation, you'll see I have a 10-period correlation, but it's long-term correlation of these. And when I say long-term, I'm talking about 20 years of correlation, 25 years of correlation, where we've had less than 10% of the time where the correlation wasn't there. And so as we're looking at this, we're nice. Can we just move somewhere safe like biotech? Now, biotech has a different volatility factor. It's not general market volatility. You have the FDA that impacts biotech and approvals and non-approvals, et cetera. So when we're looking at these, we're looking at the moves, and we start going back historically, and we can go back 25 years. We can go back as far as these charts will go, and you're going to see, and we'll use the weeklies for this. I like using 10 days on here because that's 2 weeks. Just saying, show me the last 2 weeks, whether we're still correlated or not. And we can do the same thing and say, great, give me 20 weeks. 20 weeks and give me a third of the year, better than a third of the year. And if we look back historically, we would expect to see, and you have to scroll into 1 and -1, this high level of positive or inverse in this case, correlation, positive to the VIX, inverse to this pair, correlation. Oops, I missed the 0. Now, how long do we have to have a correlation that leaves from maybe 3 or 4 weeks in the last 15 years before you think there's a correlation that's tradable? It's not causation. Do not think it's causation. Don't get confused with causation, correlation, and coincidence. You could also add confusion into there. Causation and correlation are not the same thing. Causation, this made this happen. I'm not looking for causation here. I'm looking for correlation. I'm looking for a statistical edge, not something that's causing this to happen. If we're cutting rates, then the demand for a currency that is cutting rates drops. That's a causation. If you can only get 4% instead of 4.25, 3% instead of 4, 2% instead of 3, because we're cutting rates and going into quantitative easing, there will be less demand for that currency. That is correlation, causation. It is driven by we don't want it no more. Okay, that's causation. This is correlation. And the correlation is all it's trying to do. I don't care what caused it. I really don't. I care, can I get a statistical edge in my favor for the reward risk ratio that I'm going to trade for? That's all I care about. And when we see that the demand for the dollar's gone down, the demand for the pound has gone down, the demand for the euro has gone down, the demand for the Canadian dollar has gone down, because they're all cutting rates, then yes, it's the exact causation, not correlation, that gold went up. Because we know that those currencies are weakening, the value and demand for those went down, and the fact is that the inflation is going to go up, and so we hedge out to gold, and it's the reason why gold is up 1% or more in every major currency on this planet. It's gold, Jerry, it's gold. So as we're looking at this, you could trade into gold. And this is why at the very beginning I said, and this is the reason why we're going to look for trades, not just in gold, but if we're going to see this, and monetary policy has a tendency historically, if we start cutting, we don't just do one and done. It doesn't happen very often. It's we cut and we cut and we cut. As we look at this, I don't need to go back all the way down. But by the way, the currency is inversely correlated because we have less demand for the currency. We drive that one down while the volatility rises, right? So that's an inverse correlation. If what I'm saying is true, then what should we expect with gold? When volatility is rising, gold should also rise. That's an inflation hedge and a volatility hedge, and we'd expect it to rise. Now, the correlation doesn't always work with direct to the VIX because it's not a VIX volatility play. It can be, there's still correlation, but it's also very sensitive, obviously, to interest rates. This is a combination, interest rates and volatility. Where is our volatility? Based off the last 10 weeks, we'll leave it there and then we'll drop down to the daily. We're at 73% positive correlation to a rising VIX will benefit gold. A rising VIX will benefit gold. So as we look over here, we're on the 10 days, the last 2 weeks, we have 73% implied volatility, or sorry, 73% correlation with gold and volatility. If you think volatility is going to rise, if you think these central banks are going to continue to cut or cut more in the future, gold is going to bounce here. But I don't have to have gold bounce. I've commented this before. If gold just maintains this near record highs, if it goes up, even better. But if it just maintains here, if it doesn't sell off any more than what we've done, then that would say look for the metals and miners. Look for specifically the gold miners, but this is the time to buy the miners. And the miners will also give you, let me pull up the chart here, or the tape here. It's not going to be great for XME, but on individual miners, you're also going to get a yield there. So you also can get a dividend. This is only 0.4 on XME, but you look at something like Freeport or Newmont, 1.24, new core. Just see which one has the best interest rate here. New core is 1.4. Again, you wouldn't make decisions off of this. This is just a bonus that you can get paid 1.38, 1.4% on these individual stocks that are in metals and mining. So that's the first one. I'm looking to buy metals and miners. I'm looking to buy gold stocks, but not gold directly. I don't have to. If it just holds anywhere from where we're at, then I also get that 1.5%, 1.3% dividend. So that's the first one. 1.3% dividend, 1.2% dividend on metals and miners. And as long as gold stays near where it's at, this should pay you out. Okay. Where else? Where else would we expect inflation pressures to cause these things to move or not move? Where else would we look? If we're cutting rates, what would your bet be? Where would you expect to see opportunity? If we look at the, say, utilities, which are one of my favorite ones to use instead of bonds. If we're looking at utilities, I would expect to see an opportunity to bounce here, just like gold. Utilities will pay about a 3.5%, 4% yield as well. If we're looking at utilities, we're looking at metals and miners. They're paying us dividends and they don't need to move. If they continue to move like they have in the past, it means even more. If we're looking at this and saying that bond prices are dropping, or sorry, bond yields, I said prices, I meant yields. Bond yields are dropping, then these are likely to move higher again. And so we get the benefit of both the appreciation of the ETF and the dividend in the ETF as well. So utilities, metals and mining, specifically gold miners, bonds, all of these are set up to move higher. And normally, I would also bet on home builders. But you know, I don't like these guys. I think they are in a dangerous, precarious situation. And we've sold off from the high 118 all the way down to 100. So we saw an 18% drop. Hang on 1 second. All right, sorry. Apparently the guy stopped by to look at my roof. So I'm being told. Anyway, so as we're looking at this, home builders have dropped 18%. Are you willing to bet on them? If interest rates are being cut, here's the thing. We saw pending home sales today. We saw existing home sales. We saw new home sales. Pending is those under contract that have not closed. And pending home sales fell to 0%. So didn't work very well, right? We didn't see growth. Why did we not see growth in pending home sales? Why did we go from 4% last month, 4% growth, to 0% when interest rates fell to the lowest level they've been in months? Even with the low interest rates, and I always use, as I talked about yesterday, I always use CGI, or sorry, the 10-year, as the indicator because we do mortgages based off 7 and 10 years. We don't do mortgages off of 30-year bonds. Banks lend off of 7 and 10-year, and they'll give you a 30-year mortgage, but they lend off 7 and 10-year notes. So what you can do is you can take this number, 3.997, and add on. You can add on 2% to that, and that'll give you roughly what the mortgage rates are going for today. If we went from all the way up here at 4.6 down to 4, so we went from 6.75, 7%, we're almost 1% better than we were 6 months ago. And we saw this reach record lows this month. Then why did we not see more home sales? Why did we not see more pending home sales under contract if we can borrow at lower rates? Lowest rates have been at 6 months. This is not where I want to be. I do not want to be in home builders. If we're not seeing the demand and we're not seeing that move, even with record low prices, I don't expect a lot to come out of home builders. I could be surprised, we could reverse, but it's not a time I'm buying in. So I'm looking for bearishness in home builders. I'm looking for bullishness in metals and mining and specific gold miners. I'm looking for bullishness in utilities. I'm looking for bullishness in bonds. All of these are setting up for a long-term trade that could take months, quarters, and years, depending on what the Fed does today and ongoing. But right now, the Fed's flying blind. The Fed doesn't have the data either. They have some of the data. They have some of the data that didn't get reported. I know they have some of the data, but they're not getting any new data. We're at record length closes. That means no GDP, that means, or shrinking GDP. It means we're going to have a negative quarter because the government spending has stopped, theoretically. Yep, Fed has additional. Heidi, which one are you referring to? Are we in backwardation? For those of you that don't know what backwardation is when we have current prices, meaning front month futures, are higher than later on future prices, meaning current prices are higher than future expected prices if you look at the futures charts. And so generally speaking, that's what we're saying is we're expecting fading and prices to drop, right? That's what that backwardation is generally doing. One thing to keep in mind as well is that backwardation in gold, you have to adjust for cost to carry a little bit, but yes. And we can, let me just pull that up just so you can see. I really ought to do the chart like Brandon does. I like how his chart sets up. But if we were to put gold on, let's take a look. And what we're going to look at, gold's not in backwardation, not that I can see. So I always just look at these prices. So here's the active month, meaning the current month is December. And the prices here are 4,009 for December. If you look out to March, each month goes higher, higher, higher. So gold is not in backwardation. Were you talking about oil? We peak out for June 26. So that May 25 is the highest level. And then we get a little backwardation by June of next year. Maybe you're talking about crude, which we will circle around and talk about oil here in just a second. Oil is in backwardation. This is a sign that we don't have demand and we don't expect demand. 60, so 60, 60.25, 59.96, 59.80, 59.76. All of these are sliding lower and lower and lower until May. Then we uptick from 59.76 to 59.80. At least that's what I see. You're welcome. So yeah, we do have backwardation in oil, which means the future does not look positive. We're not betting strong on oil bouncing here. So if we go through and take a look a little closer at oil, and let's talk about energy, oil and energy, even though we're going into the cold months, we say, oh, we got heating oil. We're just kind of holding here. The expectation in the future is still sliding. We have backwardation in oil. And so this bounce today, you might be careful with it. Lower interest rates theoretically means more spending. And I like, like Tony, like Gianni said yesterday, the average consumer, if you save $10 at the pump, you spend $20 at the store. We overspend and we spend any money we save on one side, we spend somewhere else. And so even though this is bouncing a little bit today, I just be careful, like as Heidi is pointing out, we do have backwardation, which means the future expected prices here is lower than the current price. And that goes all the way out till May. And by the way, if you have normal pricing for gold and backward pricing in crude, that's another sign of stagflation. That's just one more sign that we have inflation, but no expectation of demand and growth. Add that to the government shutdown, and we do have stagflation and probably falling GDP, maybe even negative GDP over time. And so it's something to be very aware of. And we do have backwardation in copper, at least until March of next year. So we have similar situation in the utility-based commodities. Not when I say utility, I mean used, not hedged. We use crude, we use copper. We don't hedge unless we're a producer. So, all right, any questions? Please explain why GNRC with volume and money flow with monkey bars. Why is the market going up? Because currencies against currencies are based off of purchasing power. Assets, including equities, are based off of the currency they're denominated in. So if we're expecting lower and lower rates, we're expecting easier borrowing, we're pricing in easier borrowing, doesn't mean that the economy is growing. The economy and equities have never been the same. We've gone into recession months before equities peaked out. And so we do not substitute commodities, or sorry, we don't substitute equities as a substitute for the entire health of the economy. And when you have the entire AI sector in a Ponzi scheme with each other, it's going to create artificial inflation of value. Equities are not a substitute for economies. Hyperinflation in that currency will make it look like equities have gone to the roof, gone through to the moon. Because you got to remember, I've got General Holdings here. General Holdings is quoted in US dollars. So if the currency weakens because we're cutting rates, the demand goes down for the US dollar, assets in that currency that are physical assets and soft assets theoretically are going to go up. The only time that that won't happen is if the demand for the alternate thing is falling faster. So crude has backwardation. It's pricing in lower demand than what the dollar's purchasing power is losing. That's why crude is not going up. If it was all about the dollar weakening, crude would go up too. But crude demand, because we don't have growth, because it's stagflation, not inflation, not growth with inflation, it is stagflation. It's the reason why key assets like copper and crude are falling, while the dollar is losing purchasing power, and other assets like gold and equities are going higher because the dollar's purchasing power is falling, just not falling as fast as the demand for physical assets like copper and crude. Does that make sense? Now, you want me to read GNRC? GNRC, anytime you have an earnings, you got to be aware that you can get a lot of reaction response. What we have happen, we've got a breakout. We hit the fair price, fair price, fair price. We're at fair price. This is where the market mathematically has said, based off of September, this is what we think is fair for GNRC. Volume never went negative, and we got above the average and tested the average and stayed above. So right now, GNRC is still saying we're accumulating. Even with the gap down and close up, we're accumulating at what is reasonable or what is mathematically a fair price right through there. So we're at fair price, but you got to remember this month ends Friday, and so we'll look at all again. Is it Cheaton? We'll look at this again on Monday. Yeah, so the 6N and 6J are the exact same volatility as the dollar yen. It's just the inverse. The dollar yen is the dollar quoted in yen, and the 6J is the yen quoted in dollars. So they're going to have the same volatility if you're trying to trade these currencies. And reality is, this chart may look volatile. You might think, oh, those swings are big. But reality is, even in the last 6 months, we've gone 8%. 6 months, we've gone 8%. Compared that to equities that have gone 30, 40, 50, 100%, some of these in 6 months. So it's a lot less volatile than what other assets are. So yeah, you could do the 6N, which is the New Zealand dollar, the 6J, which is the Japanese yen quoted in US dollars. And we just trade the trade. The hope, Timothy, is Do you care which way these are going to go? I've just told you, I'm a buyer of metals and mining and those companies. I'm a buyer of utilities. I'm a buyer of bonds, because if we're going to expect those rates to be continued to cut, those are all opportunities to be bullish and collect dividends. Even if the market doesn't continue to move higher, we just kind of hold, we can collect dividends on all of those. And they will continue to make money, and the metals miners will continue to make money. The gold miners will continue to make money if gold stays up here at the high. So if gold hedge stays here, metals and miners are at peak margins. And so that's opportunity. I see the good news is opportunity as traders, opportunity as trading, up or down. We don't care. If we're looking to say, well, you just told me that I shouldn't bet on oil companies. Great. So what do? We go to XLE. We look at the stocks inside of there. We find the ones that are going to be struggling, the ones that have the least margin, the least opportunity, and we start selling premium against them. We start selling call verticals on the stocks that are the worst in the energy sector, the ones that have the least beneficial price action, the least beneficial debt structure. And we sell and we sell and we sell. And we collect premium, we collect call verticals premium on that, and we take advantage of what the market's going to do. We go back to home builders and say, Toll Brothers has some of the worst financials in that area. And if we couldn't get a rally out of the rest of the market on the lower rates, we couldn't get more sales, even though it's rising today, I'm going to look for it to fail at 148, or sorry, 141, and sell call verticals, or just sell calls if you want to take that risk, but sell calls or sell call verticals up here. Another opportunity. And I should be able to mathematically price it out. I won't do this until I see what we do tomorrow, because if we close right there at 141 tomorrow, well, then Friday we start a new, or Monday we start a new monkey bar, and I'll need to get new numbers. But if the premiums are good, absolutely, I'd be willing to sell at 142. And I'd sell the 144s, give me some space to breathe and collect. I generally like selling deltas near, if it's a monkey bar level, closer to the 42. If it's not a monkey bar level and I'm just looking to say, hey, it looks like it's slowing down, I like to sell closer to 30, 33 deltas. So I have a statistical edge. The main thing I want to do is I want to get paid 25 cents minimum per dollar wide on those calls, those verticals. Okay, that means if I do a 250 wide spread, I need at least 63 cents. If I'm doing $5 wide spread, I need $1.25. That's the absolute minimum, but I like to sell deltas between 30 and 40. And my edges that I don't like to go past are 42 and 28. Generally, you're not going to get paid enough at the 28. But I'll sell the higher delta if I already bounced and rejected the 141. I will sell that one. Does that make sense? Clear as mud? So the hope is there's always opportunity. Do you know how much money was made in the 2008 financial crisis? We also know how much money was lost. What's the difference between whether you were making money or losing money in that scenario? It's whether you knew how to take bearish positions. It's whether you knew where you could find safety. Kalturs, I exit on closes past this. If this were the setup right now, if I were to sell a call vertical right as it failed at 141.81 and I sold the, say, 143, okay, I don't exit based off the loss, because even if it goes to 145, 146, I'm not at max loss. I prefer to sell verticals on calls. I will sell puts on things that have dividends that I want to own. Just sell naked puts, but selling calls, I do the verticals. So if I'm in this trade and it closes past my technical exit, closes say to 142, closes above this high, then I say, okay, whether I've won or lost, let's cut it off. If I collected, like we're just proposing, if I collected 65 cents on a $1.50 or 250 wide, and it goes up there and now it costs me $1.20, yeah, I'd rather take a $55 loss because it broke resistance than let it lose the entire 190 or 185. I'd rather lose a $55 loss and be done. If it goes towards my target, I want to get 85 to 90% of whatever I got paid. So when we get close to about 15 cents, it's not worth hanging on to at that point. Just not worth it. Now I can run the numbers on it. I don't think this is, like I said, I don't think we're done here. So I don't want to go too aggressive into this, but what's the trade look like? What does the trade look like? If we were to look at ITB, oh, I'm sorry, Toll Brothers, not ITB. Toll Brothers. Keep in mind, if we just shorted the stock, we would be liable for that 71-cent dividend or 0.71, 25-cent dividend. But the next dividend is not paid until January. So you could just short the stock if you felt comfortable with that. But I also want the ability to say, if it doesn't move, I still get paid. The problem with Toll Brothers is they don't have weekly options. So we have to kind of only deal with this. I like to sell 3 weeks though. 3 weeks would work. If I sold 3 weeks worth, where's my delta between 30 and 40? There it is, 38. I would sell this one. It's $5 wide, so I'd hope to get paid at least $1.25. I get paid $1.45. Let's run the numbers really quick. If I sold this today, and I could get 145, I mean, the market price is 125, but if I could get 145, my risk is 355 because it's a $5 wide spread. $5 minus 145 credit is 355 max loss or risk. So I'm getting paid about 40% return on risk, right? Did I do my math right? 3, 4, 5. Yes. So I'm getting paid. I'm really what it comes down to. I won't accept anything less than 33% return on risk. This is about 40%. My probabilities say, since my risk is 355, my probabilities say I have to be right 71% of the time. The delta I'm selling, does that work? Am I selling a 39 or less delta? The answer is yes. We already saw that we were selling a delta of 38, so I have maybe a 1 or 2% edge in this. If we want to analyze it, we can right-click, analyze trade, and set our slices to break even. Now we're going to do that under risk profile. And let's reset slices and set slices to break even. Statistically speaking, for that to be a winning trade, I need to be right 71% of the time. And this says I'm going to be right 67% of the time. So this does not price statistically for the probabilities where I want it to be. I want an edge in, some edge in my favor. And it's not giving it to us. So if I got paid 145, even though the premium works for the delta, the return on risk versus the probability of success is right there, close, but not good enough for me. So I'd wait until tomorrow, wait till it tests something, wait till it fails, see if I can get paid better, and then I'd consider taking the trade. I generally want to see a couple of percent edge in my favor, or at least pot odds, meaning equal odds to the probabilities. PBET says if you're selling premium, you get 50% in a day. Do you hit the door on that trade? I generally don't have that as one of my rules. It makes sense, so I have no problem about that. Winning side, though, generally, if I got paid 65 cents or $1.45, I just do fast math and say, when I can buy it back for somewhere between 14.5 cents, that's 10%, or 21.75 cents, then that is 85%. So I've gained, if I can buy it back for between 14 and 21 cents, then I've gained 85, 90% of my max potential. There's no reason to hang on to it. The statistics go against you. I've run the numbers 1,000 times. I would say 1,000,000 times, but that's not real. I have probably run it hundreds of times. And it's not worth hanging on to for that last 5 cents. If I got sold it for 65 cents, what is it? 6.5 cents to about 10 cents. So if I'm in that 6.5 to 10 cent time window or price window, or I'm in the last 10 days and it moves against me, then I'm going to pull the plug. All right. it is time for me to wrap this up. I will be doing, for the 10% club, we do have a coaching call today. And we do have that coaching call at noon, right when the Fed meeting is. So we'll talk some Fed meetings. We'll talk about that in the 10% club. I know I'm going to be competing against Don and Garrett and everybody else. We're going to be all over the board. It is Fed day, so you need to be aware as a Fed day, there's a lot going on. And so with the Fed day, we'll still get some reaction. We'll still get some responses. I still like all of these instruments. I still like all those areas. There's opportunities to trade bullish and bearish. Not in spite of what's going on, but because of what's going on. These are all opportunities because of what's going on. Brandon is in the house. He's going to take you through the next, I don't know, next session. We'll just call it session. Okay, there we go. An hour.
Well, 50 minutes because Don's got a special event coming up here at the top of the hour, of the next hour. So we got to jump off a little bit early. He's got to play his music, right? I mean, what's Don going to play today? Maybe some Stevie Nicks in there. Is it going to be some Slightly Stupid?
Well, it could be that song Jerome. Have you heard that song? Yeah, there's a song called Jerome.
A little Powell action or
Lizzo.
Oh, Lizzo. Yeah. There we go.
Lizzo sings a song called Jerome.
That's why I don't know it.
Oh, yes, man. But it has some language in it, so I won't repeat it here.
All right.
All right.
All right. Okay. All right.
So I got it.
Well, what's the shirt today, though?
Oh, shirt is. We've got the main theme.
Oh, there we go.
We got the skeletons on the arms. And we got the main moon picture on the middle. Yep. Halloween shirt of the day.
It's pretty
slick. 2 more days.
Only 2 more days. We got to find a new shirt after that. All right.
All right.
See you, Blake. All right. Desperate.